Have you felt the strange and unprecedented shift in the car market lately? It truly feels like something unthinkable is happening, with prices soaring and choices dwindling, leaving many of us scratching our heads and wondering what our next steps should be. Today, we're cutting through the noise to understand what's really going on. We'll meticulously explore the complex web of factors from global events like the pandemic to rapidly changing buyer habits that are fundamentally reshaping the automotive landscape right before our eyes. Get ready for a deep dive into the latest data, revealing the hidden truths behind the headlines and equipping you with the essential knowledge to confidently navigate this turbulent ride. One of the most striking and alarming indicators of this market shift is the significant reduction in active car buyers. A staggering 1 million potential buyers have simply vanished from America's car market. This isn't just a minor dip or a seasonal fluctuation, it represents a major demographic and economic change with long-term implications. People are either actively delaying purchases, finding themselves unable to afford increasingly expensive new vehicles, or prudently choosing to hold on to their existing cars longer than ever before. This shrinking demand profoundly impacts everything from manufacturers' production strategies to local dealership inventory levels, creating a challenging environment for all. The shockwaves from the COVID-19 pandemic are, surprisingly, still very much hitting the U.S. car market with full force. Back in 2022, we witnessed new car sales bottom out dramatically as global supply chains buckled under pressure and assembly lines were severely hobbled by unprecedented shortages of crucial components like semiconductors. These profound disruptions didn't just disappear when the lockdowns ended. Instead, they created a powerful and persistent ripple effect, leading to fewer new cars being produced, which in turn severely restricted the availability of newer used cars down the line. It's a fundamental supply-side problem that continues to exert upward pressure on prices even today. This brings us to a crucial and often overlooked point about the used car market. Vehicles that are approximately 3 years old are widely considered the gold standard for used automobiles. They typically offer a superb balance of modern features, remaining warranty, and depreciated value. However, precisely because new car sales bottomed out in 2022, there's a significant deficit of these highly desirable 3-year-old vehicles entering the used car market right now. This artificial scarcity creates what experts are calling the used car squeeze, driving up demand and keeping prices stubbornly high for shoppers desperately looking for reliable pre-owned options. Despite these inherent challenges, the data reveals an interesting and somewhat perplexing paradox. Used cars are actually lingering on dealership lots longer, even as their average prices continue to stubbornly climb. Edmunds, a leading and respected automotive resource, highlights this counterintuitive trend, indicating that both shoppers and dealers are facing a truly difficult and uncertain environment. This suggests that while there's a definite scarcity pushing prices upward, consumers are also becoming increasingly hesitant and price-sensitive, often unwilling to pay these elevated costs. This results in slower turnover for dealerships, creating a delicate and unstable balance that impacts the entire used car ecosystem. It's truly a complex and intertwined picture. Recent reports from October 2025 indicated that U.S. vehicle sales were actually up for the third quarter, a seemingly positive sign. But here's the kicker, the critical detail: simultaneously, inventory was significantly down, and overall affordability suffered severely across the board due to intense pricing pressure. This means that while some vehicles are still selling, the average consumer is finding it increasingly difficult to afford them at current prices. The market isn't necessarily slowing down in terms of total units moved, but it is becoming a much less accessible market for many, highlighting a widening gap in purchasing power and economic disparity. You might logically be wondering why used car prices aren't seeing a significant drop if sales are slow for some models and overall affordability is suffering. Well, analysis from Edmunds in early 2025 highlights a crucial and close relationship between the new and used auto markets. Put simply, the persistent challenges in new car production, coupled with elevated pricing, directly influence and prop up used car values. Therefore, we really shouldn't expect used car prices to drop significantly in 2025 because the underlying systemic issues affecting new car availability and cost haven't adequately resolved themselves. It's a deeply systemic problem, not just a temporary market fluctuation. With rising monthly payments, higher interest rates, and overall elevated prices for new and used vehicles, Americans are making a very pragmatic and practical choice. They are consciously holding onto their cars for much longer periods. This isn't just anecdotal evidence, it's a profound and significant shift in typical U.S. car buying habits. Instead of upgrading every few years, consumers are now opting to maximize the lifespan and utility of their current vehicles, extending their ownership. This decision is predominantly driven by current economic realities and a strong desire for financial stability in these uncertain times, directly contributing to the 1 million buyers gone statistic we discussed earlier. While tremendous anticipation surrounded the rise of electric vehicles, the market is currently experiencing a significant and undeniable slowdown in sales momentum. EV sales are notably falling, despite substantial promotional efforts from manufacturers and strong environmental pushes from governments and advocates. This retreat isn't solely about the initial high purchase price, it's a multifaceted issue. Buyers are carefully weighing the perceived benefits against rising monthly payments, lingering range anxiety, and, surprisingly, another major and often overlooked cost factor that's making EVs less attractive for some segments of the population. Let's delve into what that hidden and impactful cost truly is. One of the most unexpected and significant hurdles for widespread electric vehicle adoption is the escalating cost of insurance. MarketWatch, a reputable financial news source, reports that coverage for EVs can be anywhere from 10% to a staggering 135% higher than the national average for comparable gasoline-powered vehicles, depending heavily on the specific make and model. This drastic difference in insurance premiums significantly increases the total cost of ownership, making EVs less financially appealing for many potential buyers. This stark realization by insurance companies about the higher repair costs and unique risks associated with EVs is a death blow for some, indeed falling sooner than anyone might have thought. In stark and noteworthy contrast to the falling EV sales, hybrid vehicles are absolutely thriving in today's market. Buyers are actively and intelligently choosing practical, fuel-efficient vehicles over expensive upgrades, and hybrids fit this bill perfectly. They offer the compelling benefit of improved fuel economy without the persistent range anxiety or the potentially prohibitive insurance costs now increasingly associated with pure electric vehicles. This surge in hybrid popularity signals a major and sustained shift in U.S. car buying habits, clearly prioritizing immediate utility, proven reliability, and tangible cost savings in everyday driving over futuristic, yet currently more expensive and complex, alternatives. Looking back over the last decade, American car culture has been dramatically and irrevocably reshaped. Sedans and other traditional passenger cars have steadily lost significant market share, while larger, more versatile crossovers and SUVs have surged emphatically in popularity. This isn't just a fleeting trend, it's a fundamental and enduring shift in what modern buyers expect from a daily vehicle. Consumers now consistently prioritize versatility, a higher driving position for better visibility, and increased cargo space for active lifestyles. This profound preference directly influences manufacturers' production lines and dealership inventories, dictating the types of vehicles most readily available and aggressively promoted to the public. Beyond individual buyer choices and vehicle preferences, broader macroeconomic factors are profoundly and significantly shaping the entire auto market. J.P. Morgan's esteemed chief global strategist, Dr. David Kelly, wisely points to the intricate impact of international tariffs, fluctuating consumer confidence, and overarching economic factors on car sales and industry resilience. When consumer confidence wanes, as it often does during periods of uncertainty, big-ticket purchases like new cars are frequently delayed or postponed. Tariffs, or taxes on imported goods, can inherently increase import costs, which are then inevitably passed on to the consumer. These collective economic headwinds create a challenging and volatile environment for both automotive manufacturers and discerning buyers alike, ultimately affecting market resilience and long-term investment opportunities. So, with all these forces at play, what does the immediate future hold for the car market? The outlook, according to deep and comprehensive market analysis, strongly suggests that the automotive market is set to decline significantly by 2026. This isn't just mere speculation or a fleeting prediction, it's based on robust and comprehensive data projecting continued fundamental shifts in supply, demand, and persistent economic pressures. The myriad challenges we've discussed, from the lingering pandemic effects to rapidly changing buyer behaviors and consistently rising costs, are converging to create an environment where the market is widely expected to contract even further. This forecast is absolutely crucial for anyone planning a major purchase or considering an investment in the automotive sector. Given these complex and dynamic market conditions, what should you strategically do if you're currently looking to buy a car in the near future? Historically, some of the biggest gains for smart investors and savvy consumers come after the worst market downturns, when opportunities emerge. However, for a major car purchase, waiting indefinitely until things feel entirely safe might mean missing out on certain, fleeting opportunities, or conversely, getting caught in another unpredictable price surge. It's truly a tricky and highly personal balance. Consider your immediate transportation needs, your overall budget, and crucially, the long-term total cost of ownership, especially factoring in those surprisingly high insurance costs for EVs, before making any hasty or ill-informed decisions. In summary, the global car market is undergoing a profound, multifaceted, and likely irreversible transformation right before our eyes. We've seen how lingering pandemic shortages created a powerful domino effect, ultimately leading to the current persistent used car squeeze. Overall affordability is undeniably suffering, even as some sales figures manage to tick up in certain segments. Buyers are increasingly prioritizing practical, fuel-efficient hybrids while EV sales slow considerably due to rapidly rising costs, particularly surprising insurance premiums. And critically, this isn't a temporary blip. Experts confidently predict a significant market decline by 2026. Understanding these powerful underlying forces is absolutely key to making intelligent, informed decisions in this complex and rapidly evolving automotive landscape.